Good morning and welcome to the NDI Checkpoint Web Conference, Non-GAAP Financial Measures. We'll give everybody about a minute to log into the system and then we'll go over some housekeeping on the next slide. Let's advance to the next slide and then we can go over some housekeeping. Questions can be entered via the Q&A widget open on the left-hand side of your screen. We will address questions at the end of the program, time permitting. If you experience technical difficulties during the presentation, please visit the webcast help guide by clicking on the help button below the presentation window, which is designated with the question mark icon. The PowerPoint presentation will be available on our website at Foley.com in the next few days, or you can get a copy of the slides in the resource list widget. Foley will apply for CLE credit after the program. To be eligible for CLE, you will need to log into the On24 session and answer a polling question at the end of the program. If you did not supply your CLE information upon registration, please email it to hpapadakis@foley.com. Please note, certificates of attendance will be distributed to eligible participants approximately 8 weeks after the web conference via email. Note, those seeking Kansas, New York, and New Jersey CLE credit are required to complete the attorney affirmation form in addition to answering the polling question that will appear during the program. A 5-digit code will be announced during the presentation. Email the code and form to hpapadakis@foley.com immediately following the program. We can now advance to the next slide where our speakers will introduce themselves. Thank you.
Hello, this is Mark Plichta. I'm a securities attorney at Foley & Lardner. I've been doing securities and disclosure work for about 18 years now here, primarily for 33 and 34 Act clients. My practice also focuses on mergers and acquisitions, corporate governance, and activist and takeover defense. Prior to becoming an attorney, I spent 4 years with Arthur Andersen as an auditor, so I do know enough about GAAP and non-GAAP to be dangerous. Chris?
Thanks, Mark, and thanks to everyone who's joined us on the call today. Again, my name's Chris Hodges. I'm the founder and CEO of the Alpha IR Group, a firm which has carved out a reputation as the premier IR-only consultancy in the U.S. I've been an IR consultant for about 2 decades. I've worked with investor relations officers, management teams, and boards of public companies across all industries and generally across most market caps as well. At Alpha IR, we help specialize and help our clients build smart, efficient, and effective IR programs. This includes messaging, investor visibility support, activism, preparedness, and defense, as well as proper IR measurement and reporting. Adopting a proactive approach to your IR programs is as critical today as ever, given increased regulation, proliferation of high turnover hedge funds and activists, the accelerating transformation on Wall Street, which we're going to talk a lot about today, I think, as we get through this presentation as well. Our team generally works with internal IR teams and helps round them out both strategically and through an execution of support function. So we're pretty versed as well in the non-GAAP communications topic. It's been near and dear to our heart over the last year, and so I think we're well versed to give you the communications perspective on that today. We're headquartered in Chicago. We also have teams in Boston and New York, and Bobby is actually the co-head of our New York office, so I'll let you introduce yourself, Bobby.
Thanks, Chris, and again, thank you, everybody, for joining us this morning. I joined Alpha IR Group just under 2 years ago. Prior to that, for almost 25 years before that, I spent about 14 years on the buy side as a portfolio manager with Zessiger Capital Group in New York. We vested in mostly equity, but really all parts of the capital structure. So a lot of experience investing directly in companies, the equity of companies, but also from the fixed income side. We also engaged in private investments as well, and served on the board of a number of private companies during that time period. Prior to that, I spent almost 10 years in the 90s as a sell-side analyst. starting off at First Boston, but most of the time at Bear Stearns. So prior to joining Alpha IR, I really brought over 2 decades worth of experience in really what are, from an IR perspective, the 2 main constituencies, if you will, of public companies, both their owners or their prospective owners, and then the analysts, broadly speaking, who cover those companies. I also do sit on the board currently of a small public company in New Jersey, where I'm a director and I am a member of the audit committee there. So I've got a pretty broad experience in terms of working with or being one of the key consumers, if you will, of public data that is put out by companies, and focusing on some of these key issues, including what we're going to be discussing today in terms of GAAP and non-GAAP disclosure issues. And with that, I'm going to turn it back to Chris, who's going to review our agenda for today's call.
Thanks, Bobby. I'm just going to take a few minutes and kind of set the foundation for our discussion today. This non-GAAP topic has obviously been reported on extensively over the last year. I know a number of you are still struggling with it today in terms of making your communication crisp and clear. I think we've got a unique approach for you today. We're going to try to blend both the legal side of this topic with some of the practical realities that we know a lot of the IROs out there have with the need to both educate investors consistently as well as communicate effectively. Mark, Bobby, and I have been a part of multiple internal discussions across our clients on this topic, quite honestly, since Reg G came out in the early 2000s. In a handful of cases, I think it's safe to say we've even seen somewhat heated arguments inside companies between GCs and the IR function itself in terms of making sure that these communications end up clear. Our audience today, and I was just kind of zipping through who's on the call, and I think it's pretty safe to say we've got a mixture of both legal and IR professionals, some of which look new to the role. Some of you I know have been in the profession for a long period of time. So we're going to take a pretty balanced approach and holistic approach to things we're going to talk about today. So in terms of the agenda, Mark's going to walk us through the basics on the non-GAAP discussion, specifically, what is a non-GAAP metric, what's the history behind Reg G, and what really were the implications of last year's new directives. We'll then present kind of the pros and cons discussion across the use of non-GAAP metrics. We'll move into a couple statistics that will really outline the realities of non-GAAP usage today, as well as the impact that these new directives are having on the investor communications process. More specifically, we'll focus in on the earnings process, where it's been the most cumbersome. Bobby's going to put his old buy-side and sell-side hats on from his former lives. He'll walk us through kind of Wall Street's perspective on the topic. And at the end of the day, Wall Street owns 95% of most of the people on the call stock it, and they're our primary audience, and that's who we're really focused on. We'll move into a review of recent comment letters and enforcement actions. We'll close with some practical advice for all of you as you move forward before we open up kind of a 10 to 15-minute Q&A session, depending on how we're doing on time. So with that, I'll pass the call back to Mark.
Thanks, Chris. So again, covering briefly some of these basics. What is a non-GAAP financial measure? A non-GAAP financial measure is a numerical measure of a registrant's historical or future financial performance, financial position, or cash flows that either excludes an item that is included in the most comparable GAAP number or includes an item that is excluded from the most comparable GAAP number. You can see the language below if you wanted to have all the details. I just would point out that the key things to me here is that it covers both historical or future information measures, and we are talking about financial measures. We're not talking about, for instance, operating measures. That actually leads to the next slide. Some things that are not included. It does not include operating measures or measures that are derived from solely from operating measures or solely from GAAP financial measures. Non-GAAP also does not include financial measures required to be disclosed by GAAP, commission rules, or system of regulation of a government agency or an SRO. An example of this that you may have experienced along the way is a lot of companies have segment profitability information that is not GAAP but is required under, I think, codification section 280, and you'll often see that, and you would not necessarily have to comply with some of the SEC rules, which we'll talk about in a moment. You see on the right of the slide some common examples of various non-GAAP measures. I won't run through them. I think most of them will be at least somewhat familiar to almost everyone on the call. So a little bit more deeply into the basics, Regulation G and Item 10E of Regulation SK are the rules that govern non-GAAP. These rules were adopted by the SEC in early 2003. To kind of set the stage for that time, we had just come out of the dot-com bubble and the bursting of the bubble. And during that, the bubbling up period, investment bankers and corporations have been quite aggressive about using non-GAAP metrics, in large part because a lot of these internet companies did not have earnings, or in some cases did not have revenue. So they had to create kind of new adjusted metrics to kind of fill the gap, no pun intended. And so there was a lot of criticism for that. Also, and I don't think this was the main driver, but keep in mind too that this was also the time when we were seeing a lot of this fraud renaissance with the companies like Enron and Quest and Adelphia, et cetera. While those were not about non-GAAP at their core, they were fraud issues. At least some of those companies, for instance, Quest, did have some non-GAAP issues that kind of added to their mix of issues. So the SEC adopted these rules, and just to give you a basic idea of what they cover, Regulation G applies to all public disclosures of material information containing non-GAAP financial measures, whether or not it's included in an SEC filing. There's various requirements that must be met. Number one, the non-GAAP measure cannot be misleading. And the precise wording you can see there on the slide, but suffice to say that it basically follows your typical language for a 10b5 type anti-fraud provision. There's also disclosure requirements. A non-GAAP financial measure must be accompanied by the presentation of the most directly comparable GAAP financial measure. It must also include a quantitative reconciliation between the non-GAAP financial measure and the most directly comparable GAAP financial measure. This includes forward-looking information, forward-looking measures to the extent they're available without unreasonable efforts. To be honest, a lot of companies will rely on the unreasonable efforts to not include a reconciliation for forward-looking information, i.e. guidance, but but that rule is out there, and please be aware of that. Turning to the next slide, if you have oral disclosures such as on an earnings call, it's obviously not easy to, for instance, describe a reconciliation orally. So you can just post the comparable GAAP measure and reconciliation on your website and then disclose that website and its availability on your call. Turning to Item 10E of Regulation SK, that applies when a non-GAAP financial measure is included in a filing with the SEC. It also applies to earnings releases that are filed under that are furnished under Item 202 of Form 8K. Requirements are similar, but a little more expansive than what you find under Regulation G. Again, it cannot be misleading. That's not hardly surprising. But you see more issues on the next page, some more differences. Again, you have to have presentation of the most directly comparable GAAP financial measure. But here, there is a requirement that the presentation must have equal or greater prominence. And we'll certainly talk a little bit more about that when we get to the NDI discussion that's coming up in a few slides. Again, you have to have a quantitative reconciliation between the non-GAAP and the GAAP and the most comparable GAAP measure. You must include a statement disclosing why management believes the non-GAAP financial measure provides useful information to investors. And then to the extent material, a statement disclosing the additional purposes for which management uses the non-GAAP financial measure. Just to comment on these latter 2 points, the last one, again, is only required if it's to the extent it's material. So you do not necessarily have to have that disclosure. Also, that if you do include that disclosure, that is not a replacement for the disclosure above regarding why the non-GAAP measure is useful information to investors. Some companies have gotten into issues for that. They have not really explained why the GAAP measure is useful to investors. They've focused on why they use it internally. And in the very public example, Tesla was criticized by or I should say, received questioning from the SEC about this and ultimately had to change their disclosures because of this issue. There are certain non-GAAP practices that are prohibited, including excluding cash-settled items from liquidity measures, identifying adjustments as non-recurring, infrequent, or unusual if they're reasonably likely to recur within 2 years. So for instance, if you have restructuring charges that are recurring, that can be problematic. There's also a related C&DI that's different, but covers some of the same ground that we'll discuss later on when we discuss SEC comments that are out there these days. It's also prohibited to present non-GAAP measures on the face of financial statements or pro forma financial statements. And you can't use titles or descriptions for non-GAAP financial measures that are confusingly similar to GAAP measures. While this might seem obvious, I've had discussions where we were trying to find a good label for a non-GAAP measure that was similar to earnings from operations, and someone suggested operating earnings. That would be a problematic item. There are certain exceptions from Item 10E for M&A disclosures and registered investment companies. While it's not noted on the slide, there's actually an exception under Reg G for M&A disclosures as well. So that's kind of the ancient history. The more recent history is in 2016, and that's probably why a lot of you are on this call. It started with the SEC in May 2016 issuing certain C&DIs, or compliance and disclosure interpretations. There's a few that I think a lot of us practitioners have focused on. One is on the placement and prominence of the non-GAAP and the GAAP measures. The C&DIs make it clear that the following disclosures of non-GAAP measures are more prominent and therefore non-compliant. And just to highlight a few of these, one, headlines. If you omit comparable GAAP measures from an earnings release headline or caption that includes non-GAAP measures, that is a problem, and the SEC will give you comments about that. Ordering. If you use a non-GAAP measure that precedes the most directly comparable GAAP measure, that is a problem. You have to put the GAAP measure first. Style. If you present a non-GAAP measure using a style of presentation such as a bold font or a large font that creates emphasis for that non-GAAP measure, that is also problematic. Just a couple on the next page, highlighting the first bullet point, the descriptive words. If you talk about your non-GAAP measure and talk about your record performance or exceptional or words like that, but you don't have a prominent discussion or characterization of the comparable GAAP measure, the SEC considers that a prominence problem. Similarly, at the bottom of this page, if you have a long discussion of an analysis of your non-GAAP measure, but you don't talk about the related GAAP measure, that is also a problem under the prominence rules. Another area of focus is liquidity measures. Non-GAAP liquidity measures that measure cash generated must not be presented on a per-share basis. This is not new, but I think the SEC has, again, actually none of these issues are really new in a sense, but the SEC has kind of fleshed these out with their C&DIs. The prohibition depends on whether the non-GAAP measure can be used as a liquidity measure, even if management presents it solely as a performance measure. And in this case, how the staff use it is they're going to focus on the substance and not how management characterizes it. And I think the key here, the great example that you might see where this would come into play is free cash flow a liquidity measure? And in the SEC's eyes, it is. It's not a performance measure; it's a cash flow measure. So you can't do that on a per share basis. Another SEC interpretation was that if you're presenting a non-GAAP liquidity measures, you must also include the 3 major categories of the statement of cash flows. That's very practically awkward, so that is something I think people have taken note of and been frustrated with. Lastly, there are some tax impacts too. The SEC has explained that a registrant should provide income tax effects on its non-GAAP measures, but that disclosure will depend on the type of measure it is. If it's a liquidity measure that includes income taxes, it might be acceptable to adjust GAAP taxes to show the to show the taxes paid in cash only. On the other hand, if a measure is a performance measure, you should include the current and deferred income tax expense commensurate with the non-GAAP measure of profitability. You should not provide the show the adjustments, a non-GAAP measure net of tax. You actually have to show in the reconciliation a tax item, a tax line item as one of your adjustments. And with that, I will turn it over to Chris.
Let's go to slide 15. We're going to talk about why non-GAAP measures are so important. Quite honestly, we see routine situations where GAAP accounting introduces significant complexity into the investor communications function, in particular, again, in the quarterly and annual financial results discussions that we do. And it really behooves companies to make sure that they are providing other methods to help investors more easily understand the real drivers of their performance from an operating performance perspective or a financial and liquidity position one as well. In particular, a lot of investors, especially those that follow value disciplines, are extremely focused on free cash flow, and they use that measure to value your company based on the expectations for future free cash flow generation and growth. So GAAP doesn't help a lot with that discussion, and again, that value component of the universe is a very important one and a very sizable one as well. Additionally, as a public company, you have to remember that you're always competing for capital with other public companies. That doesn't just mean your direct peers. And that often means you're competing with other companies that fit a similar risk profile within portfolios as you at the end of the day. And that really presents two communication challenges. Number one, to be comparable to your most direct industry peers. If your peers are making reconciliations and providing greater transparency than your company is, you risk significant messaging gaps ultimately in your story. In terms of competing for capital, maybe against non-direct peers, it's critical that your IR departments are making your story as clear and as easy to understand as possible. And often it's non-GAAP metrics that will help you do that and help your potential investors better model your company as an investment. Another reason people use non-GAAP is some of you have used debt to finance your business. Therefore, in those cases, you have financial covenants related to the use of leverage, and most of those are non-GAAP in nature, EBITDA being the one that we see clearly the most often. In high leverage situations, potentially like that, investors become laser focused on covenants, and thus companies in those positions will routinely focus their communication pretty directly on some of those covenants, and you've got to balance that out obviously now with GAAP and your non-GAAP terms. There's also certain sectors and industries that don't conform perfectly to GAAP. The real estate, investment trust, or REIT industry is one of the easier examples, where free FFO or free funds from operations are used instead of earnings per share. And along those lines, too, there are certain industries that can hit various points of the life cycle curve where non-GAAP measures are really needed to communicate effectively. I think in the last year, the energy space is probably a great example where you've got significant business model transition, in a few cases even business disruption, that have led investors and corporates to focus on EBITDA, free cash flow over earnings, especially for a lot of small and mid-cap E&P concerns. And lastly, in today's world, many of our core stakeholders continue to get stretched. For example, several of you are followed pretty prolifically by the media. Media tends to is in a rush to report the news as quickly as possible as they can today. That tends to make them headline readers. Introducing GAAP into those headlines makes that often very confusing. And if you're not taking the time to think strategically about your headlines, your subheadlines, any of your other communication techniques that you're using to communicate your story as an investment, I can guarantee to you that when you see news stories about your company, it's not going to tell the right picture if you're not balancing this communication out appropriately. And as we've talked about a few times, and I'm sure we'll come up a few more times today, the Wall Street's transformation is really accelerating. Sell-side analysts are covering twice as many stocks as they used to. Buy-side analysts, who are really the focus of what we're talking today, actively managed funds are losing a battle against passive management today. Both of them need your help in terms of explaining your story as efficiently and as effectively as possible. On slide 16, we try to provide kind of a practical example here. Let's say this XYZ on our page is pulling together. It's a pre-public company framing up their S1, pulling together their expected kind of future guidance and approach to IR communications. being counseled by their bankers, obviously pretty explicitly. Hopefully they've got good legal counsel and IR consultants like Foley and Alpha. Of course, we make a nice team. But as XYZ kind of reviews the communication approaches of their 6 peers, and by the way, the 6 companies on this page are real. They're primarily large cap technology companies. You'll immediately see that a number of them are calling out numerous non-GAAP measures. I listed 9 core adjustments here. There actually were another 8 or 9 smaller adjustments that each of these peers had been making individually over the last 2 years as well. The larger adjustments on the page, which are pretty consistent, I think, in today's communication, were stock-based compensation, acquisition-related costs and integration expense, and then restructuring charges. So if you're XYZ's board, management team, legal, IR functions, and you decide to take a conservative approach to communication and focus primarily on GAAP, and I think there's no doubt that the company's operating performance, net income, earnings growth will all be uncomparable to this direct peer group. And the risks of that obviously are investor confusion, misvaluation. It can lead ultimately long-term to credibility gaps. And while probably not a driving factor, it could certainly contribute to some kind of an activist situation if it does impact the company's credibility. So if XYZ wants to compete effectively for capital, we'd say that there's no choice, that they're going to need to be a little bit more proactive and provide a series of non-GAAP communication really to round out their communication. And with that, I'll kick it over to Bobby to talk about some of the drawbacks.
Thanks, Chris. Moving to slide 17. The reality is that there is a pretty big divergence between GAAP and non-GAAP results as reported. The table here included on this slide, again, like Chris shared on the prior slide, these are 10 real examples, 10 mega cap stocks, and if anything, based on our experience, this table actually understates the difference. If you go back, you go down a little bit in the market cap size range, but again, using within the S&P 500, or you go back different years, you are going to find examples that the percentages are much, much greater between GAAP and non-GAAP. And that's an issue. That's a problem when you've got huge differences between reported and adjusted reported results. The reality is that it's not surprising that we have this. And again, we've touched on it already a little bit. We'll talk a little bit more. Is from a buy side perspective in particular, but from the broader community, there's a need to and a reason why non-GAAP measures are around and are useful. Having said that, management teams are largely incentivized in the system that's gone up over the last couple of decades to produce good results and growing results, and that's what their pay is based on. So not surprisingly, they're incentivized to report good results or to call out items that they don't believe are representative of the true core earnings power, both current and future, of the company. And this is what leads to a lot of these big adjustments, some of which we'll cover in the next couple of pages, that there's a couple of, in particular, big ones where we're looking at restructuring charges, M&A integration costs, equity compensation, and some of these are more tied to certain sectors than to others. Because of human nature, this can lead managements to exclude the bad or take out the bad costs, what they don't consider the true costs of the business, true representative going forward, but it doesn't always lead them to exclude ones that are good for their results, but maybe non-recurring in nature. Eventually, for some companies, this leads to them pushing the envelope to bad behavior, and ultimately that's going to impact their credibility with the investment community. Ultimately, it's going to impact the stock. In our experience, usually when the rubber meets the road on that is when something changes ultimately in the business model, i.e. the growth story that was growing is no longer growing as fast. The M&A story where they've done a lot of acquisitions in the past, they are not finding them as easily, not at the right price, too expensive, they're not doing as much. All of a sudden, the wheels start to appear to come off, and all of this past behavior in terms of adjusting for non-GAAP items starts to become basically the ammunition for short sellers and other players in the market that want to call attention to this behavior. So again, I think there are good reasons for non-GAAP measures, and we'll cover those more in the next couple slides, but they do present some problems, and they do lead ultimately in certain cases to problematic behavior.
So we're going to move to slide 18 and talk about some recent trends that we've seen. We've got a year under our belt with these new directives. I think we've seen a lot of companies take these obviously very seriously. Almost all companies obviously have as well. And given the SEC's focus on this, you'd actually think that the use of non-GAAP measured had been somewhat curtailed possibly in the past year, but you'd be wrong. In fact, public companies are actually using non-GAAP measures more today than any other time in history. If you go back to 2006, 75% of companies used at least one non-GAAP item. By 2015, we were up to 88% of companies, and as recently as the fourth quarter of 2016, which we talked about in February and March generally across most of the universe, 96% of companies use some form of a non-GAAP metric within their investor communication materials and or discussions. And it doesn't just stop with earnings materials. The chart on the upper right of this page shows you that companies are also using non-GAAP items in other places. For example, within proxy statements, the use of non-GAAP has actually tripled over the last 7 years. There's really three primary adjustments. We've hit on these a few times, and I think most of you are generally focused on these three assumptions in the pie chart on the lower right. Restructuring charges are really the number one source and are nearly 50% of the reasons companies are making these types of adjustments. M&A and integration costs are the number two. Even for somewhat serial acquirers, are still ultimately making these adjustments over the last few years. And then lastly, stock-based compensation, and as Bobby talked about, particularly in the tech community, is the third largest source, and everything else is generally about 4% within that pie chart. Moving to page 19, I've tried to include a little bit of a practical example or two here about this earnings process, which is, I think where most of us have had this discussion. The focus started, and it was pretty clear, I think, in the SEC directives as they attacked a number of issues they had seen in press releases. I think most companies have really focused on the earnings release. Mark talked a lot about the discussion really being around equal prominence and placement for GAAP and non-GAAP metrics, and you can see that in the example that we've provided for you on that page. And also, we've got a number of kind of forms and templates that we like to use to help our clients really communicate effectively. In particular, the use of subtitles to reflect kind of our elevator speech. What's our critical message we want investors to walk away with? We like to use bullet points at the top of releases to really help sell-side analysts and or buy-side analysts who are jumping from call to call to call throughout the earnings process because it's so condensed. Give them a quick and easy way to make sure they understand what are our key messages this quarter at the end of the day. As you can see in this not so hypothetical example, quite honestly, below, which came from a company about a year and a half ago, we have to rethink kind of our approach to these titles, subtitles, and bullets a great deal now, where we could use crisp, clean information. We've now got to make sure we're giving equal prominence and placement to GAAP, which is, as Mark talked about, usually you're doing first to be safe. So we've also got to be thoughtful about our use of adjectives and fonts as well in these releases. Another interesting change that we've seen across a couple of our clients involves the use of tables. A lot of companies will use tables to try to cut down on the number of words in their releases. Bobby and I actually had two cases with clients that were using non-GAAP oriented tables, and based on, especially right after these directives came, based on legal counsel and the length it was going to add to a release to add an applicable GAAP table, both of those clients chose to eliminate one of these tables from our release. It was, I think, in the third quarter of 2016 that we did that. What was interesting was Wall Street's reaction. We actually had a pretty negative and visceral response from both the sell side and the buy side for those two clients. They felt the table was necessary in explaining some of the segment information that they needed in order to do their modeling. Based on that feedback, we actually added those tables back and obviously had to add in a GAAP component to that as well. Another press release outcome that we've seen out of this, and it's an unfortunate one, but the complexity of this process, I think, has caused a lot of companies to shorten their releases. A number of companies are moving almost to a page and a half format because they don't want to put in extensive tables or get into the weeds with information. They're choosing to wait for their script as well. We really counsel most companies that the press release should stand on its own. If there are real key critical elements that we need to communicate in the script, they should also fall into the release. So we'd actually look at that as an unfortunate result kind of that's come about in this process. Go to page 20. I'll just quickly hit on a couple other the earnings support documents that we use or that the IR profession generally uses and that certainly all of you on the legal side are a part of creating as well. And that would be the earnings script. Most companies, or I'd say about 70% of companies, are using some form of a PowerPoint to guide that discussion as well. And then obviously there are several of you that are using guidance within that communication. So first, as it relates to investor PowerPoints, I think most companies haven't changed their approach too much. They've obviously added in the non-GAAP reconciliations. We've seen expanded appendices as needed in those documents as well. But for the most part, they're taking similar approaches. Whereas the press release was extensively changed in a number of cases, the use of PowerPoints is fairly straightforward. The one thing, though, there are several companies out there who actually 8K those PowerPoints to be safe from a Reg FD perspective. A number of those companies we've seen have stopped 8K'ing. That goes through the SEC. It makes that document, in their camp. You can use the website as a disclosure vehicle, and so a lot of companies who used to 8K PowerPoints have stopped doing that. In terms of earnings scripts, I don't think there's been a lot of changes really from a scripting perspective. Most companies are still using that to get deeper into the weeds on the issues within their stories. They've had to add some GAAP items if they didn't in the past. But for the most part, I think people's approach to scripting is fairly similar. Guidance has been a hot topic and a tricky topic for a number of our clients. I can say most companies haven't really shifted their approach to guidance at that stage. Even serial acquirers, even companies who have lots of adjustments that might be considered more routine in nature really haven't changed their approach. So if you used EBITDA as one of your primary guidance vehicles in 2005, you're probably still doing it today. As Mark talked about, there's a clause within this, within the new directives that talk about the idea that if it's an unreasonable kind of burden to come up with that appropriate GAAP metric, it can be avoided, and so most companies have cited that as the reason that they're not giving GAAP guidance necessarily at the end of the day. And quite honestly, we don't see investors in the sell side really asking for that kind of guidance either. So from a big picture perspective, it's a year later. I can tell you the IR profession continues to be a little bit frustrated with this process. It's made it much more difficult to communicate, but I think it has been addressed fairly significantly and across most of the work that we've seen and the work that we've done. And with that, I'd like Bobby to kind of weigh in on, again, having been both a buy-side and a sell-side analyst. I think Bobby can offer a little commentary on what the street thinks of this.
Thanks, Chris. Turning to slide 21, there are players, mostly from the buy side or on the short side, that do make a big deal of specific companies, specific issues on this in certain cases. But by and large, it's really not a big deal, particularly for the buy side, and frankly, not for the sell side either. Frankly, because they've got bigger issues and business model challenges to deal with. I think it's helpful to step back for a second, separate from the overall legal questions and all the other framing issues, which are very important to understand that in the case of GAAP, we're dealing with, importantly, something that is about, accounting, of course, of the past up to the present. That's what the GAAP is about. It's absolutely necessary. It is very useful, but ultimately it's about history. We're investing, and what the buy side is doing, and really what this is all focused on, because public companies, this is about disclosure to their current investors and their prospective future investors. That's what their time period is, the future. Okay, and so the GAAP measures and history are very important to understanding a company, understanding an industry, but nonetheless, it is the future that matters to an investor. And in essence, when any investor, any institutional, let alone individual, takes a position in a company, in a stock or what have not, in a sense, they're disagreeing with the present, whether it be from the long side or the short side. And this gets to the, I think, from the crux of why it is not as big of an issue ultimately for the buy side in particular, but the sell side as well, is because the very nature of active management, which is, our largest constituency for Alpha IR in terms of working with companies, is that they're taking a position on the future. And so they are typically looking at and making adjustments to a company's past or present and trying to figure out what's going to happen in the future that is the same or different than what has occurred previously. And that gets to the foundation of them forming an investment opinion of whether they want to commit capital to a company, invest in the stock, hold the bonds. Conversely, it also forms a basis by which they may disagree with the outlook out there and things, or the past, and things are going to get changed and not be as good going forward. And in this regard, non-GAAP disclosure issues or focusing on non-GAAP type results allows investors, allows the money management industry, allows the portfolio managers and the analysts to get to their subjective conclusions that are ultimately lead to their investment decisions. The sell side, by its very nature, is there to serve that community. And therefore, it is in their best interest to also walk down that path and try to understand the quote-unquote true earnings power of a company, both today and in the future. And if their clients, the buy side, are focused on that, then they need to be focused on it as well. And so, again, I think you're straddling, or we are straddling with GAAP and non-GAAP, these two important time periods, two necessary time periods that are inherent in the investment business. But there's going to, in my opinion, always lead to some important differences here. And you're always going to have, based on a certain participants and constituents, where their quote-unquote investment lies within a given company, so forth, whether they are long it or short it, and their view, they are going to come to somewhat different opinions on some of these measures. Lastly, I would point out that the activist community can be a very loud user, broadcast mechanism for, disagreeing with companies or highlighting these use of non-GAAP measures. But at the end of the day, it's really, they're not, it's not an altruistic function on their part. They are not an uncompensated referee at the table here. They have an agenda, and if the use or the focus of a non-GAAP measure serves their end to achieve what their game plan is, then they will gladly use it to their advantage. And with that, I'll turn we'll turn it over back to Mark at slide 22.
Thanks. So just to quickly talk about as a follow-up to the NDIs we talked about before, there have been, and just a generally more activist approach by the SEC staff, we have seen a large surge in comments on non-GAAP measures. Of companies receiving SEC comments in 2015, it was about 16% received non-GAAP comments. That almost doubled to 30% in 2016. With that said, companies have had some success pushing back against those comments. If you look in this, at some of the more common comments, et cetera, I think one area where you can see some ability to push back is particularly with comments about the inclusion of a recurring adjustment that might make a non-GAAP number misleading. So, for instance, if a company is an active purchaser and they every year they have new restructuring charges related to their acquisitions, then that could be, the SEC might ask questions about it, whether it be misleading. Several companies have pushed back and explained to the SEC why that should not be problematic. Again, this is similar to the issue of actually one of the hard rules of Reg G and item 10E, but it is a little bit different because even if you don't label the non-GAAP measure as non-recurring or unusual, it could still be misleading. So that is something, again, to be aware of, but also know that you can possibly push back. Now, where the SEC has not been as flexible is about non-GAAP revenue measures. A number of companies have received comments about including deferred revenue as like an adjusted revenue number. The SEC doesn't have a lot of sympathy for that. And just as a general matter, I don't think you should expect the SEC to waive compliance with any of the item 10E or Regulation G requirements, such as prominence. I think that is a harder sell. I would say that if you are fighting back on the substance of an SEC comment, I think it also makes sense to put in some kind of additional language, though, about why these measures are important to investors, and so it's not just about why it's not recurring and it's not misleading, but in that context, I don't think it hurts to talk about why it's important. As far as recent enforcement activity, this is actually, we have seen a little bit of an uptick, because frankly there has not been much at all in many years, and a little bit when the rules first came out in after 2003, and then we didn't see anything. In the last year, we've seen a couple of different SEC enforcement actions. It's, again, it's very rare to see a pure non-GAAP enforcement action. One of the ones we did see, I think of as more of a fraud action that involved a non-GAAP number. It's where a REIT had the CFO and chief accountant manipulate the calculation of their FFO number, and they used a fake plug number. Again, while that's involving non-GAAP, to me that's more of a straight fraud. But with that said, you do have, this is the kind of thing where people go to trial, and one trial is pending, and the other individual pled guilty. MDC Partners is another enforcement issue, and I think this is a little bit more problematic because I think this is pretty much of a pure non-GAAP issue. Here, this company used organic revenue growth, which is very common, but they didn't provide a clear reconciliation to the GAAP measures, which prevented investors from making a meaningful comparison. And so there were some other issues here involving other disclosures, but the company had to agree to pay a $1.5 million penalty to settle all the charges. How much of that is attributable to non-GAAP, we can debate, but again, I think that here non-GAAP was a pretty significant portion of the SEC's enforcement case. So this is one that, again, typically if you have a non-GAAP issue, it's going to end up in a comment letter issue, and it's not a huge problem. But you shouldn't take too much comfort because at least in this one case, there was, a pretty significant penalty that resulted from it. Chris?
And then to conclude, I'll just walk through a couple of our key takeaways. If we'd put some graphics on this page, I think, and to represent legal and IR, it could have been interesting. The legal graphic might have been a smiley face, and the IR graphic probably wouldn't have had as big a smile. From a legal perspective, these directives really made disclosure decisions much more black and white. They gave clear guideposts, whereas Reg G, people tried to work within the spirit of the rule. It wasn't taken as seriously. It was a harder conversation from a legal perspective to have. There are very clear directives, specifically aimed at earnings releases that has made this, I think, a much more easy discussion from a legal perspective. But from an investor communications perspective, it's clouded and it's become much more complex, specifically as you get into the specific characteristics of each company and how they need to communicate around. The key is to continue to balance, the legal need here against the investor need for transparency and clear communication, hopefully giving you a few thoughts to consider as you think through that. Wall Street, another key takeaway here, Wall Street wasn't clamoring for this change. In fact, The only time we've ever really seen an investor publicly call out a company for its use of non-GAAP was usually because it was part of an overall activist agenda, just another way to attack a company's credibility. For the most part, if an investor has an issue with a non-GAAP metric, which will be quite rare, they would probably communicate it through the IR function. But again, it behooves companies with this transformation going on Wall Street, with active management and the sell side both shrinking today, need to make their job as easy as you can and make sure that you're thinking really proactively and strategically about how you communicate. On page 25, and Mark talked a lot about, I think, these things, but when you're thinking about the choices you need to make and using different metrics that you want to guide the street off, here's kind of 5 core questions that you ask yourself. What's the intent of using that measure? What are you trying to communicate? Most importantly, does it really provide your core investor constituency? And all of you have very different investor constituencies. Some of you have value-oriented investors. Some of you have a more growth-focused base. Some of you, have large hedge components. So your use of non-GAAP should match that investor base. You should ask yourself, does it really provide a better understanding to not just my current investors around my investment thesis, but also my prospective investors? Will it help me tell a better story? Will it help us build our credibility and manage our credibility? Are you using that measure consistently is another one. I mean, if a metric is going to shift from year to year in terms of how you use it internally, might not be a metric that you really want to use here with the new rules. This is a really important one too. Do you measure that? Do you use that measure internally? I've had a number of industrial clients over the years who will go out and talk about their ROIC and show it to investors, and then they use ROE in terms of their executive compensation. I can tell you investors, tend to frown on the use of one metric that isn't related ultimately to incentive inside. So if you're going to use a measure, it carries a lot more weight with investors if it's also tied to the incentives you have as a management team in terms of how you're running your business. And then again, peers. The way your peers are communicating has an impact on what you're doing. Making sure you're not an outlier, again, to make it easier for your sell side to compare apples to apples, for the media to get the answer correct is pretty critical, and you've got to think about these communications, I think, very clearly as you work through this. With that, we're going to go to the Q&A session. We've already had a few of you kick in a couple questions. I've got 5 or 6 here. We've gone a little long, but we'll take the next 8 minutes here for Q&A, and thank you for those who've already submitted them. Please feel free to jump in through the portal if you'd like and ask further questions, but I'll take these 5 or 6 that I've got right now, and we'll pass them around. Mark, first question is directed at you. If you found that auditors are also policing earnings releases and scripts more carefully now, if not, should we be asking them to do so?
I have not experienced that, and I think that's because this is more of a legal question than an accounting question at the end of the day. I would not recommend inviting additional scrutiny from the auditors. I don't think you want to invite more oversight from them.
Another question here comes from a large cap IRO. Have you found yourself, both either on the legal side or the communication side, more involved in the earnings process as a result of this regulatory tightening? I can take that one. I think we certainly have seen both inside and outside counsel, I think in particular last year, but it still carries forward this year, a little bit more involved in the earnings process, especially as we've had to restructure some approaches to communication. On our side of the equation, we work with companies to make sure they're pulling together best practices in how they do things. We've started to even work with larger companies a little bit more through this process in terms of again, making sure they're putting the right story forward, and anything that makes the situation a little bit more complex tends to get us a little bit more involved. So I think I can answer for both legal and IR, absolutely. This is a critical communications vehicle, and this is added complexity to it. Bobby, question for you. I think based on your past life, do you have any examples from when you were a portfolio manager where you saw a company use aggressive non-GAAP metrics, or in your opinion, aggressive non-GAAP metrics? And if so, how did that impact your perception and your holding in that company?
Sure. Well, by and large, my own experience was to the extent of which there was an aggressive non-GAAP metrics that we were aware of or became aware of in our due diligence process, the thing that would often make me most uncomfortable and really just sort of stop the interest at that point was from a revenue standpoint. Because the comfort zone in that area was just something that we could never get there. From other ones, that are typically costs and other things that may be non-recurring, stuff like that, that was just a greater comfort zone overall in terms of my and our practice of investment and our style. And while every investor, every money management firm active has slightly different styles, or at least there are many, there's groupings of styles. My own experience in talking with people is that it's when it's on the revenue side, in terms of non-GAAP stuff, that there's the greater discomfort.
Good. Mark, this one's probably for you. There's a certain amount of momentum and pushback against or trying to reverse some of the regulatory reform that came from the prior administration. Have you seen any push in any part from the public company sector, be it boards, management, legal community, to maybe get the SEC to create a little bit more flexibility in this rule, or do you see anything coming up on the docket that might imply there'd be another review of this decision?
And I can't say that there's nothing out there but there's nothing that I'm aware of. We just have not seen that. Where we have seen issues, people have been focused, and you could say this maybe is mixed up priorities in some ways, but have been focused on things that have a lot of costs associated with them, like the conflict minerals rules is a thing that is very important with, for instance, the manufacturing associations, et cetera. But I've not heard a lot of hue and cry on this issue. Also, I would point out that while there's the NDIs came out last year and the more aggressive enforcement, the rules themselves date back to the Bush administration. This did not result from Dodd-Frank or even from the Obama administration. So I don't think that this, any repeal would have as much traction with the current administration, in my view, as other things might.
We're coming up on the hour. I think we got time for one more question. Bobby, I think this one's probably good for you. You noted your board membership as well. Kind of curious, what's been the board's perspective? Have you had a chance to kind of live through that process with them? How are board members viewing, these new rules?
Well, I think, being relatively new to it in the past year, my experience there, up front, I want to say is more limited there. But I do think that, and also though being a member of an audit committee, automatically, I think every board member is sensitive to this stuff. Perhaps being on an audit committee, you're that much more sensitive to it. So I think that my own thoughts or experience on this was that it codified where, at least for me and the others I've been around, where already their head and hearts were in terms of focusing on this issue. So it was already front and center, and in my experience so far, it remains that.
Jump into page 29. Thank you for everybody's time and attention today. On page 29, we've given you all of our contact information as well. If you have specific questions that you'd like any of us or to offer you some practical advice on, please feel free to give us a call or use those emails. If you'd like a copy of the presentation as well, please feel free to reach out to any of us, and I think both of us will post these in our respective websites as well. But thank you, everybody, for your time and attention, and have a good day. Thanks.
Thank you, everyone.
And at this time, I'm going to read the CLE code for the program. If you are in need of CLE credit today, please enter this 5-character code into the poll question on the screen after this CLE information slide. The code is G as in George, L as in Lake, 11, G as in George. Once again, that's G as in George, L as in Lake, 11, G as in George. So we are going to go on to the next slide, which will be a polling question. Please enter on this following slide where the polling question is now appearing. We'll give everyone a few minutes just to make sure that they get the code onto the slide. that appears on your screen now, the polling question, please enter it here rather than in the Q&A box. And once again, if you need the code again, it is GL11G. And as a reminder, for those seeking credit in Kansas, New York, and New Jersey, you will also need to download the attorney affirmation form, which is in the resource list widget. You'll need to fill that out and return it to Harrison Papadakis at hpapadakis@foley.com along with the code. Give everyone a few more seconds to enter in the code GL11G into the resource list widget, or sorry, into the polling question available. A copy of the PowerPoint presentation and a multimedia recording will be available on our website at foley.com within 2 to 3 days. If you have any CLE questions, please contact Harrison Papadakis at hpapadakis@foley.com. Certificates of attendance will be distributed to eligible participants approximately 8 weeks after the web conference via email. We welcome your feedback, so please take a few minutes to complete the survey before you leave the web conference today. We look forward to seeing everyone at the next NDI checkpoint. Thank you, everyone.